Well, good afternoon, everybody. I'm Rod Schulhauser, COO here at Rock Advisors. Looking forward to a great session. And if you're here for a reason because usually webinars about taxes don't draw huge crowds. But you know what? In today's economic climate, development climate, you name it, it's definitely at the top. We know it to be a big part of ongoing expenses for both development and owners. Before we get things started, I just want to let everybody know here's what's coming up. Of course, just around the corner, all of us probably have a keen interest as to what comes down on November 4th. With the federal budget and the day following, we will have a special inside discussion about how this impacts the apartment development industry. We also, a week after that, November 12th, something on estate freezes for family offices, people developing intergenerational businesses with their apartment developments. That'll be an interesting discussion. And we culminate our year on December 2nd at the Toronto Real Estate Forum. We have our annual apartment development and affordable housing conference with some great topics, great speakers as usual. And it's all part of the Toronto Real Estate Forum. As we move into next year, I'll just let you know we will have a year launch and we'll have lots of information coming out about that for the first week of January. And you can see here in February and March, we are running our annual in-depth apartment development masterclass featuring about 35 I would just call them faculty, teachers, experts in their own arenas, and we bring this all together every year with the ability to attend all 11 sessions are about 2 hours each, or you can pick and choose sessions that are timely for both you, your staff, your team, and you can use that as you like. Now, as we move into today's webinar, just want to talk about Q&A. We just keep your chat box open. If you have some questions that you think could be fielded and would be of value to the entire audience, feel free to type them in the chat box. Our speakers will address them. They may type it in, they may speak to it. I suspect that there may be some more in-depth personal kind of questions that require a one-on-one. And at the end of the webinar, you'll have access to our speakers' contact information and you can connect with them directly to get the information that you are seeking. Now, who you're going to be hearing from here today is David Gibson and Stephen Longo, two people that know way more than I have on the tip of my one small finger when it comes to municipal taxes. They know a lot about this stuff. And we're looking forward to have them. I think I'm going to have Stephen, I'm going to have you kick things off, maybe elaborate a little bit more about you and David and what your game plan is for today. Over to you.
Thanks a lot, Rod. Appreciate it. Appreciate the opportunity to present today with Dave. Yeah, just a little bit of a quick thumbnail about Dave and myself before we get going today. I'm a lawyer specializing in property tax assessment litigation. Don't ask how I got into that field, but that's what happened. And I work closely with Dave, who's a managing director at Yeoman and Company. And Dave and I have had the pleasure of working together for a few decades now. And the typical sort of setup is Dave is a valuation expert in the area of property tax assessment, and I'm the litigator, I'm the advocate. And we have the sort of advocate-expert relationship in terms of the appeals that we pursue or the files that we work on. I always like to say that what we're about is problem solving and taking some complex issues and trying to make the best of them. And that's what we do. So I'm going to start today. This is a little bit of an agenda for how things will unfold. We're going to talk, I'm going to talk a bit in a general sense about property assessment and taxation in Ontario, give a little bit of a thumbnail of the scheme. Then I'm going to address the postponed reassessment that I know you're all aware of, the 2025 tax year in Toronto, and we're going to go to an example of the Regulation 140/24, which we'll get into, multi-residential cap rates, and sort of the continuing debate on affordable housing. Hopefully, we're going to have some time at the end for Q&A, but we do have our contact information for any future questions. So this is the presentation, Property Assessment of Purpose-Built Rental, the Ontario Landscape, Challenges and Continued Debates. And I think it's safe to say we are facing in this particular asset class both of those things, challenges and continuing debates that we certainly don't have solutions for yet. All right, so I'm going to talk a little bit about the property assessment and taxation scheme in Ontario. Basically, there are separate components of how this works. So all property is assessed or valued for purposes of levying property taxes. And then the taxes, the actual taxes that the property owner pays, are based on those assessed values. Assessments are conducted by an agency known as the Municipal Property Assessment Corporation, or MPAC for short. MPAC's a public corporation. It's not technically part of the government of Ontario per se. Prior to the creation of current value assessment in 1998, MPAC, in its previous incarnation, was in fact part of the provincial finance ministry. But that all changed with the introduction of current value in 1998. And so what you have are really two different components. And that's what this slide addresses. You've got your tax base or your assessment base, which really is the determination of the assessed values that are ascribable to each kind of real property. That is conducted by MPAC and in accordance with the requirements of a piece of legislation known as the Assessment Act. And then those assessments are returned, and based on tax rates that are determined by each municipality, your taxes are actually levied. And that's how the system works. Some people have a conception that the municipality is also the assessing authority, and it's not in Ontario. Moving on to the next slide, there's a little more detail here. So I've spoken to MPAC already. Now, in terms of property assessments, they are determined based on what is known as a current value as a specific valuation date. And you can see here, I spoke to the Assessment Act, but what is current value? We are technically a market value system in Ontario, also known as current value. And at its essence, basically, it's the fee simple if unencumbered. Those words are interesting. I'm not going to get into a discourse on what that means, because I can tell you, since those words were brought into the Assessment Act in 1998, there's still a debate about exactly what's meant by the unencumbered fee simple. It hasn't, in my view, been fully resolved by the courts. But what I will say is what current value really is a market value that is supposed to reflect a notional value or reflective value as at a given base date of what real property would transact for in a transaction between a willing seller and a willing buyer. That's basically it. In other words, the notional sale price as at the valuation date in question. We are currently working with a January 1, 2016 valuation date, also known as the 2016 CVA, and the values within a cycle are supposed to be phased in. We're supposed to be in 4-year assessment cycles. So when the 2016 CVA was introduced and took effect, it was supposed to apply to 2017, 18, 19, and 20 taxation years. And then we were supposed to have a new cycle commencing in 2021, which was supposed to have a January 1, 2019 valuation date. However, with the onset of COVID in the spring of 2020, the province announced a halt to the reassessment. And now, almost 6 years later, we are still in that halt. We are still in an effective assessment freeze. We are still working with a valuation date that is now coming up on 10 years old. And as you'll see as we get into this presentation today, it's posed all sorts of problems, particularly in the multi-residential or rental apartment property tax base. So with the phase-ins, thanks. This last schematic here just explains how the phase-ins were supposed to work in theory. You can see that when a value gets introduced, it's supposed to phase in up to the increase in value over the 4 years of a cycle. So the schematic shows you what an increased value sample that had a 12 CVA rather of 162,000, how that would look at a new 2016 CVA value of 228,000. All right, now we can move on. So in terms of the municipal tax rates, they're calculated as part of the municipal budget process each year. Municipalities determine the cost of the services and the revenue they need to obtain via property taxes. And then the tax rate is determined based on the municipal budget relative to the value of all real property by class within the municipal borders. This is an important concept. And again, we'll touch on this further. So for example, you can see the calculation here. It's basically the municipal cost of services divided by the assessed value. That equals the total tax rate. And then this schematic shows you how this whole process sort of unfolds. Basically, your first step is the property assessments are determined by MPAC. The second step is those assessed values are shared with local municipalities. The third step is that the municipal council determines its budget requirements. And then finally, the municipal council sets the property tax rates in accordance with those requirements. That's how it's all supposed to work. All right, well, as I've mentioned, we were supposed to have a 2019 CVA phased in over the 2021 to 24 tax years. And in fact, had things gone according to plan, we would now be in yet a new CVA here in the 2025 tax year. But as I've said, the province has delayed the reassessment indefinitely. What we are doing for purposes of tax estimates that we're involved in is we're modeling the next reassessment to reflect the January 1, 2026 valuation date that commences with the 2027 tax year. I have to say, this is really a best guess. We don't know. We have no line of sight on what the province is thinking in terms of a timeline for a reassessment, or if they're even going to do a reassessment. The last few budgets and economic statements have simply said the question is under review. We expect a provincial economic statement within the next few weeks. So we are all eagerly waiting to see whether or not anything's going to be addressed. But for the 2017 to 26 tax years, assessed values continue to reflect those January 1, 2016 values. This includes development land rates and components of value in, for example, multi-residential properties such as fair market rents, vacancy allowance, expense allowance, and of course, capitalization rates. So we have a very stale, dated assessment picture in Ontario. Moving on. Here are some of the challenges that we've seen as a result of this stale dated assessment. First of all, market data is constrained to base and shoulder years of the valuation date. So technically, because we're still working with a January 1, 2016 base date of valuation, the general rule of thumb is you're supposed to look at what are known as the base and shoulder years, basically the base year being 2016, and then the year on each side of that base year date. You can appreciate that a decade later, that information and that data is far less probative, and that there have been some real difficulties reflecting changes in the market. For example, COVID. Obviously, the pandemic has had many impacts in many different aspects, and they are left essentially unaddressed. The market has generally obviously changed and shifted in very real ways between asset classes since 2016. And these are all things that our stale dated assessment do not allow us to address very easily. There's also been a couple of issues that have arisen in terms of how assessment appeals are dealt with. So assessment appeals are filed with a body known as the Assessment Review Board, which is a tribunal that functions in a court-like manner and adjudicates challenges of assessed values. One of the things that has emerged in recent Assessment Review Board decisions is this concept known as issue estoppel, which in a nutshell, it's a somewhat complex legal principle, But in a nutshell, what it means is that if parties have resolved valuation issues in the context of an assessment appeal within a current assessment cycle, they are stopped or prevented from relitigating those issues within that cycle. So take, for example, owner of a property who may have resolved an appeal in 2019 or 2020. You may well have had, and both Dave and I have a number of examples like this. A property owner has, since that 2019 resolution, their property has experienced a number of significant problems, a loss of tenants, an increase in vacancy, other market pressures. Absent certain change events, which I'll speak to in a moment, what this doctrine says is in 2025, when your property may well be in a whole different picture than it was 5, 6, 7 years ago, you have no ability to challenge that assessment because you already litigated and resolved that assessment earlier in this epic cycle. As the cycle goes on, this becomes obviously a far more significant problem for more and more commercial, multi-residential, and industrial property owners. And the only general exception, without getting into this in too much detail, is where the property has experienced what is known as a change event. So in other words, the property has changed hands through a sale, or there has been new construction or demolition of all or a portion of the property, or there's been a change for some reason in the tax class status of the property. But if you don't fall into one of these very specific examples, you are really going to not be able to challenge the assessed value of your property, notwithstanding what may have happened to it within this current extended cycle. Another issue that's arisen is because we've had this never-ending assessment cycle, we are finding that both MPAC and municipalities are becoming more litigious and pushing back on litigation in a way that they didn't used to be. And particularly, we're seeing municipalities playing a more active role because one of the things, and this will be addressed in some further slides, but one of the things that this extended assessment cycle has done, of course, is put great pressure on municipal budgets and made municipalities essentially more cognizant of the need to protect their assessment base and their tax base. Another issue that's arisen is what we call the Section 34 issue. Again, the Assessment Review Board has developed a practice in recent decisions of varying the valuation date in certain situations. This is a very interesting concept, and one that I have to say, I think virtually all of us who practice on the side of being advocates both for taxpayers and even the assessing authority are concerned about, because what we're seeing is a trend by the Assessment Review Board where you have supplementary or omitted assessments to consider the effective date of those assessments as the new valuation date. In other words, if you had an assessment for improvement to property by way of a supplementary assessment or a Section 34 assessment, and it was effective, let's say, April 1, 2025, the board's view appears to be that the valuation date is no longer January 1, 2016, but is January 1, 2025. This can, it's fair to say, cut both ways, but can be a significant problem when litigating assessment appeals, particularly on multi-residential properties, when looking at this new date. And frankly, in our view, there's no support for this concept in the assessment litigation. Basically, with respect to market value, what we're seeing is assessments are effectively frozen and they don't reflect current market conditions. And the shifts in value between asset classes are not being recognized. Now, I think I just see a question in the chat, which maybe I'll address quickly because I think it sort of fits in here, which is a question around appealing the assessment to the Superior Court. Let me address this quickly. There is an ability, but it's extremely limited. So how the scheme works generally is appeals of your assessed value or your tax classification are brought to the assessment review board at first instance. There's an ability, if you don't like the outcome of those decisions, to seek leave to appeal to the divisional court, but it has to be on a question of law. And I can say it's not easy to establish that potential question of law in the divisional court's mind. The divisional court in the last number of years has generally shown a fairly high propensity to endorse the decisions of the assessment review board, for better or worse. In terms of applications to the Superior Court, generally speaking, the only opportunity there is to apply to the Superior Court at first instance is where there's a question of exemption. If you believe that your property should be exempt from taxation, the Superior Court has the jurisdiction under the Assessment Act to do that. All right, moving along. So the further challenges here. Relevant market data is, no, sorry, we've seen this one. Sorry, the next slide. Okay, so why are reassessments important, and what are the implications of not having a reassessment? Well, they're vital for the rebalancing of each asset class to accurately reflect property valuation and an equitable distribution of property taxes. This is the concept of revenue neutrality, which has worked for some time now. It basically means that in general terms, a reassessment should not have an impact on the overall property taxes raised by a municipality, because in a typical reassessment, you would see assessed values change and balance or rebalance, if you will, between asset classes. And you can see sort of, there's an example here in the slide, but basically the change in assessed values should allow for the following effect on tax rates. Basically, if value growth outpaces budgetary increases, the corresponding tax rates should decrease. If values decline and the growth does not outpace the budgetary increases, there should be corresponding tax rate increase. You can see there's examples 1 and 2 here, which show how this should play out. So municipalities should be collecting more or less the same amount of revenue each year based on the approved budgetary increases. I think at that point, I do see a question here in the chat. I'm just wondering. So this is an interesting question, because it seems to speak to highest and best use, which isn't quite the question. There's a question I've seen. I'm going to turn it over to Dave, but I just want to address quickly this question that I've seen in the chat, because it seems to speak to what we know as highest and best use valuations, which has been a very controversial issue in litigation in recent years. Basically, because the Assessment Act is a current value system and based on essentially notional sale prices, one of the elements in testing the highest and best use of real property is to look at what the degree to which a sale price is influenced by, for example, redevelopment potential. And I don't want to sidetrack too much on this, but it's an important element of litigation. And there have been some interesting recent decisions, which we'd be happy to share offline, that speak to how the board is supposed to look at appeal on the whole question of highest and best use, and how to assess it in terms of both the timeline for reasonable probability of development, as well as financial feasibility of development. So with that said, I'm going to turn it over to Dave to pick up on this point in the next slide.
Thanks, Steve. Good afternoon, everyone, and thanks for taking the time. So, as Steve mentioned, this notion of a postponed reassessment, it has real implications as we move forward, and as we sort of grow in years from the last assessment cycle. We're now 9 years into this cycle. It has an impact that seems to grow and will manifest with each year that passes. So assessed values, as we've talked about, as Steve mentioned, remain stagnant. it's sort of paramount to the left side of the balance sheet being value, the right side of the balance sheet being taxes. If there's no value change on this side of the balance sheet, and there's no change in the market relative to each class, as Steve mentioned, because when a municipality establishes its tax base, it does it by class. In other words, the residential, the multi-residential, the industrial, the commercial, they're all measured individually, and they all contribute to their own sort of pool of which is then totaled for the cost of running that municipality. So if the increases in the tax base are limited to municipal appeals, as Steve referenced earlier, where that is where in the city in this case, or the municipality seeks to change the value and increase that, and or simply new construction, that incremental change is not enough to offset that stagnant value base. So outdated values plus rising costs associated with, the likes of inflation equal rising municipal budgets and thereby tax increases on an annual basis. Again, the left side of the balance sheet is frozen. The following is an example when we look at what's happened as a result of this stale dated or postponed reassessment. And I think it's pretty telling. I mean, Rod, if you can, thank you. So the focus today is purpose-built multi-res. The focus in the media is we need more housing, we need more development, we need more affordable housing. So the very intent to build new purpose-built multi-residential properties, and I'm going to use Toronto as the sort of the topic of today's discussion, and the references to tax rates are all associated with Toronto. But again, if you have property that are outside of Toronto or anywhere across Canada, we can address the same issues. For the purpose of this, I've just simply used Toronto. So as Steve mentioned, the 2016 base date of value has reference or had reference to the 2017 through 2020 tax years. And as you can see, the NT, which is the new multi-residential tax rate in the city of Toronto, or RT rate, they're both synonymous, the same rate, they had an average decrease per year in the city of Toronto from 17 to 20 of 3.37%, or cumulatively over that period of 9.36%. But then we move into this stale dated reassessment. So for 2021 tax year through 2025 tax year, the average increase as a result of that left side of the balance sheet being frozen has now left the municipalities increasing tax rates in the NT or residential property tax category of 4.72% on average per year, or 25.84% over the last 5 years. So think about it. This is the very class of property that we read in the news every day. We need more housing. And when you build that housing over the last 5 years, you've now achieved or been a party to a 25.84% increase. And that increase is going to get larger and continue to grow because that left side of the balance sheet is frozen and we don't have the rebalancing of the asset base. So moving on, Ron. So again, if we look at tax year 2025, the City of Toronto. The City of Toronto announced the proposed municipal levy of 6.9% this year for the NT properties. And the municipal tax increase remained between 2 and 5% each year between 21 and 2024. So what we found is that as we grow farther out in time, that increase is growing. This increase has a significant impact on the properties, both in the residential and the new multi-residential tax class. The provincial education rates remain unchanged for 2025, and this equates to approximately a 5.4% increase in the residential rate. That individual rate, or that increase, is measured at about $39 per annum for $100,000 of assessed value. In reference, and again, this is where I think we really have to focus and understand the impact. The traditional multi-residential property in the City of Toronto, and that would be cataloged as your MT property, your 1960s Class B purpose-built multi-res that are subject to rent control. The increase in the rates by the City of Toronto trended just above 3% for 2025. That increase for the NT, the newest part of the new multi-res in the City of Toronto, increased 6.9%. The reason, quite frankly, that the MT rate only increased 3% was because, as you may know, if the rate is at 3.5% or above, then the landlord has the right to go back to the landlord and tenant tribunal to seek above guideline increases. So what do? They keep it just below the 3.5% rate. In reference, commercial rates, the CT rate in the City of Toronto has gone up 2.09%. But again, it's trending up higher each year as we get farther away from that reassessment cycle. Turning the page, so what we've done is I said, okay, as Steve mentioned, for the purpose of budgets, and this is an important concept of what we do on a daily basis and a weekly basis, is we project out for our development clients what that purpose-built multi-residential building is going to be worth when it's finished and what tax load will be carried once that building is finished and completed and then occupancy begins. And this is the largest segment of our practice today, is that forecasting and modeling assumptions. And so, as you can appreciate, and our clients are getting more and more frustrated with this program because it's basically a dartboard. We don't know. As Steve mentioned, we're modeling a 27 tax year with a 2026 base date of value. And again, that's a best case, best guess, but it is subject to change. And it is subject, obviously, to provincial direction. But we have to forecast out. So what we do is we say, okay, let's take the stale dated 2016 base date. Let's also then forecast what it would reflect if we did get a reassessment, and what does that look like? And so we do both. And then we refresh and we do it again a year later, so to speak. And it's very frustrating. So what we've done today is I said, okay, let's look at this assessment cycle. We have a 2016 base date, and we're focused as of, in the context of this discussion in the multi-residential category. So if I take your traditional 1960s older purpose-built multi-res in Toronto core, this is a live building, this is a real asset. I've just removed the titles and the address. And the following slides will set out the return value today, 2016 market value, and the corresponding 2025 taxes that are charged. We then carry a reassessment model to January 1st, 2026. And in assisting us in that process, we've also looked at this asset because it was conveyed in the open market, willing buyer, willing seller. We've done the same exercise in the second example for your purpose-built AA brand new NT multi-residential building, again, Toronto core. We've looked at how that is valued today by MPAC and ourselves, and then what the taxes are trending on that asset, and then what does it look like tomorrow if we go through the reassessment. So let's look at that first example. So this, as I mentioned, is a traditional 1960s building. It carries the MT tax rate. And that MT tax rate in 2025 is 1.19%. And that 1.19% is then multiplied against the return value of 21,352,000. And you can see in the chart above that you break down the unit count, you apply a fair market rent to each of the suite types, 1, 2, 3 bedroom units. You apply a vacancy, you apply an expense allowance. And again, this is a 1960s building, so your expenses are somewhat higher than your traditional new build today, and it carry principally at around 54%. The cap rate return for these asset types in the City of Toronto proper in the core is 3.25%. And the value is 21,352,000 after we went through an appeal and we had a market adjustment applied to it of 2.9 million. So the taxes today on a per door basis on this asset are $2,531. We forecasted out what the tax load will be based on our forecasted assumptions looking to 2026, and they round out at just over $2,600 a door. Now, let's turn the page and look to what happens to this asset if we go to that notional reassessment in 2026. I mentioned that this building was conveyed to the open market, willing buyer, willing seller, and it closed on July the 30th, 2025. The base date of value in this case is January 1st, 2026. We've taken a look at the sales, we've taken a look at the time-adjusted factors, and we've made a minor adjustment up to reflect that new base date of value of $39,000,004. We've also looked at this asset relative to the rents that are being achieved today in the open market, and then valued that asset looking at the characteristics of the market as of January 1st, 2026. And both were very close to that 39 million position. So for the purpose of this exercise, I ran the taxes based on the 39 million. And this is very important. So obviously we go from a value that was at 21 million to now a value at, call it 40 million. So the value has gone up significantly, in fact, almost doubled. What happens, and this is actually a discussion that Steve and I have daily. If your value goes up, and as Steve mentioned, the municipality has to look at generating revenue just enough to cover the cost of that obligation. And so when values go up and we look at each valuation and each asset class, we have to value that asset class and the contribution that that asset class is now going to contribute in support of that tax rate. And so when we look at each of the asset classes in the City of Toronto as of January 1st, 2026, base date, we then have to reset that notional tax rate along with the value. So we look at the value and then we also reset the tax rate. As I indicated, the tax rate for 2026 in the MT category in Toronto, we've budgeted 1.26% against that assessed value. You can see in the chart here, 2027, we've modeled 1.05%. So that tax rate is coming down exponentially because of the increase in value in support of that new base date of value and the contribution to that MT asset class. So my taxes are trending now at $2,707 per door. So a slight increase. Yes, it's about 3.5%. And I'll go through that in a minute. But what we're seeing is if you look at the relative change in 28, 29, and 30, we're now at about 2.5%. So what we're seeing is despite the fact that we've been 9 years since a reassessment. And that's not to say that every building is going to be treated in the same light, because every one is treated. You have to look at where it's coming from, to where it's going, and to what that contribution is in that asset class within that municipality. And so that reassessment will allow for that rebalancing and redistribution of that asset class. So now let's do the same exercise looking to the purpose-built multi-res in the NT class, the newest class, and how that's treated and how does that forecast in. And again, we've gone through the same example. This is a property that we were involved with, and we went through an appeal as well, and we got it down to 27 million even, which offered us a $3.6 million reduction. And the taxes today in 2025 are rolling out at $31.11 a door. Taxes are trending a little bit higher in your new bill. Your rents are higher, your expenses are less, and in this case, trending at 31 a door. We're trending at 3,300 and change a door for 2026. This asset also was conveyed into the open market at 48 million, and it sold in November of 2024. It's an institutional building sold to an institutional buyer. I time adjusted that sale, and I come to about 54 million using the same parameter. I've looked at the asking rents and the contract rents today, and I've modeled it looking at that. And again, I'm within a very close proximity to that 54 million. So for the purpose of this exercise, I carried the 54 as my value going forward. And again, in this case, our tax rate for 2026 in the NT category, again, the new multi-residential category in the city of Toronto, is 0.80%. We forecasted that increase in value and the corresponding decrease in the tax rates, looking at the contribution to that asset class. And in this case, I'm looking at NT. So it's the NT buildings and it's the RT buildings and your residential tax base as a whole in the city of Toronto. And so when I add up that pool and that contribution, I'm trending to about 0.68 in year one, down to 0.47 in year four. So those tax rates are trending down as the value and the phase-in of that reassessment gets implemented. So the taxes in year one are trending at $35.50 a door as an estimate, and down and up to $39.71 in year four. So looking at that globally as a net basis, as I indicated in the first example, my year one increase on that older style building is trending at about 3.5%, but then it falls off and trends to about 2.5%, just above inflation. And in the new multi-res, I'm trending year one at 6%, but then I fall to 3.5%. So in this example, we demonstrate that by rebalancing, I'm moving away from this 6 and 5 and 6 and 7% increase annually that we're seeing today against no change in the asset base. And I'm moving to stabilize and to streamline where we can look to manage those year-over-year increases in taxes. And if we don't act soon, this increase and these reassessment figures will only manifest and get much harder to swallow, because everybody looks at it and says, if we have a reassessment, my value is going to go here and my taxes are going to go through the roof. They're not. They will in some circumstances, yes, but there are mechanisms within the city or within provincial policy that can also protect those increases above and beyond a certain level. So that's a different debate for a different day. But my point here is that reassessment, and we've gone through lots of them, and in the 42 2 years that I've had the pleasure of playing this game, we found that by allowing the reassessments to take place and the rebalancing of those asset classes, we find a much more level and manageable tax base to which we can then budget and build from. I mean, if you think about it, it's the very class of property that every time you open up your phone, your newspaper, your computer, whatever it is, we need new purpose-built multi-res. And that purpose-built multi-res is being hammered. NT classes, RT classes in the city of Toronto, 25.84%. How long can that new build developer or that manager of that asset sustain that? Because you can't pass it back to the individual tenants. Because as we all know, multi-residential, it's a gross lease. Landlord pays the obligation. So now let's move to what, in spite of a reassessment, the Ford government and its current legislature has said, well, let's look at how we can create some opportunities within a municipality. So in April of 2024, they announced the O.Reg 140/24. And this is what we refer to as NT 2.0. So we have your MT, multi-residential rate, that's applicable to your 1960s purpose-built multi-res. That carries a 1.19% tax rate. We have your NT rate, which is your newest build in the city of Toronto, and that carries a 0.077 or 78 percentage rate. So that's 50 basis point spread. And then the government came in and said, okay, we want to promote reassessment. Sorry, we want to promote new build. So we'll give the municipalities tools in order for you to act and for them to look at new multi-residential buildings with a reduced tax rate. So that O.Reg allows a given municipality up to 0 to 35% offset to the NT tax rate. In other words, instead of charging 0.078% times the assessed value, that individual municipality could actually reduce it by 35% per year up to 35 years. That NT rate, by extension, and looking at the City of Toronto again, so the City of Toronto said, we'll take it on. We'll look at it. And York Region just did it as well in Aurora, as an example, as another municipality. And there's a couple of others that are modeling it right now. But let's look at the City of Toronto, because let's stay there for now. The city said, we're going to look at it. We'll give you 15% off, up to 15% off. So if you pull a building permit after November 14th of 2024, and it's to be a purpose-built multi-res within the City of Toronto, you can apply for that NT 2.0. Wonderful. Let's look at how that's going to work its way through the system. So as I said, if your building permit is pulled, and that includes your shoring permits, if your building permit or shoring permit is pulled after November 14th, you can qualify. The municipalities that have adopted it, in this case, is the City of Toronto. Who will fund that increase, or that tax break, sorry? That tax break will be funded in the City of Toronto by your MT tax category. In other words, that very asset class that has a 1960s plus minus year built, that has a CapEx expenditure that is beyond, because of its life cycle in those buildings, is greater. Those assets are subject to rent control. And now they're faced with the burden of having to help pay for the NT 2.0 building down the street. What impact will this 15% offset have on the valuation? So we took a look at it. as I said, and as we all know, rent paid by a tenant in a multi-residential building is a gross lease. Landlord is on the hook for that expenditure of taxes. So if my tax rate goes down, so does my expenses. If my expenses go down, my NOI goes up. So MPAC looks at it and says, perfect, thanks. The value just increased. So how much of that 15% offset in the city of Toronto actually flows through? So let's take a look at it. Now, I know there's a lot of data on this slide, and I'm just going to highlight it. But the 15% offset is and applies to only the municipal portion of the tax rate. It doesn't include the education portion. So out of the gate, that 15 now becomes 12% because the education portion is not included. So that 12% is now the baseline. And then as I indicated, my expenses are going down. So MPAC, as the assessing authority, looks at it and says, with my expenses down, my NOI is up. So let's take what I would normally apply in the third chart at a 42% expense ratio. I'm now going to move that down to 39 in the bottom chart. And as a result, when it's all watered down and I get right to the bottom line, my net reduction for 2025 is 7.41%. So my 15% offset now becomes 7.41. I mean, sure, it's a reduction, absolutely, and it'll help. But what have we done? We've burdened the very class in the MT category, that's the oldest in the housing environment. We've now created an inequity between MT, a greater inequity, because your MT carries 1.20 tax rate against your 0.078 tax rate. So that's already 50 basis points, so to speak. And now we're going to come down another 15 or 12 basis points off on that. So now we've created a greater inequity between the three asset classes, the very asset classes that we're trying to promote and bring into one level. In other words, whether you're renting or you own a single family home, the taxes paid on that per door basis, all things being equal, should be a straight line. They should be level. Why would one be any different or should be any different than the other? So by introducing this offset, Bill 140, all we're doing is creating a bigger inequity, a larger disparity between the very class of property that we're trying to promote redevelopment on. And so it doesn't have the intended outcome. And so we've been very vocal with the City of Toronto and the larger municipalities, expressing that we should be looking to items like a community improvement plan, a CIP, or an IMIC grant type idea. The IMIC grant is in the City of Toronto. It doesn't have a home in the residential market, but if you look at a CIP outside of the City of Toronto, they're very relevant. Steve and I probably have 35 or 40 of them under management right now where we're working through. And that's an agreement that the municipality is carried out with that individual developer or landowner or building owner, that over a 10-year period, there'll be an offset on taxes if you build this building. So it's an agreement that happens below the line, what we refer to. MPAC doesn't look at it. So it has no impact on the value, and the offset flows right through to the bottom line. So we said, why look at a measure that just creates a greater disparity between the same asset class that we're trying to create a consistent and equitable distribution of the taxes, when we can look to something so simple as an agreement under a CIP. And so we are promoting that debate very hotly rate each of the municipalities. So moving away from moving away from taxes and going back to the base roots of assessment, there's a number of other debates that Steve and I find ourselves in and continue to debate, and that is this cap rate. And I'm sure you saw on the charts below that I had in the previous slides. Why are we applying the same cap rate to a building that is built in 1960s, is subject to rent control, and if that tenant who's been in that unit or number of tenants in those buildings vacate, and I renovate those units and I can turn those units, I can increase the base rent because I'm now moving out of the rent control. Why is that cap rate at 3.25 the same cap rate as my newest AA building right down the street, where I've market to market, I'm not stabilized, the risk associated with that asset is significantly different, and from an appraisal perspective, the two asset classes from a valuation perspective are not the same. MPAC doesn't look at it that way. MPAC says, no, they're the same. We're going to treat the old and the new and the ugly the same cap rate. And by the way, income achieved within a building and or location have no impact on the cap rate. It's funny. Every appraisal test I've ever written or wrote had reference to seems to put that at the top of the page in terms of reference. Newly constructed multi-residential buildings, in our opinion, should carry no less than a 4 cap in the city of Toronto proper. And Steve and I have gone through approximately 15 new build cap rate appeals on new build in the city of Toronto, and we've been successful in negotiating anywhere from 3.7 as an effective rate to 4.25 as an effective rate above the 3.25. So this is a continued debate that we have, and we have about another 15 buildings in line right now and or that are coming online that will form that continued debate. So it is one that we are hotly contesting, and we're not accepting the outcome. They are very different, and they should be reflected as such on the valuation. Another very hot topic within MPAC, and Steve touched on it earlier in his comments, was the affordable housing debate. MPAC does not delineate between the two, market and affordability. They're the same. They should be valued on the same basis. If my market rent is $2,500 for that 1-bedroom unit, then, and despite the fact that I've got a 20-year term sheet that was established under my Section 37 agreement or my 111 agreement with the planning department for the city of Toronto, that I have to provide 30% of my units to be an affordable category. And unless I do that, I can't build to that 40 stories or that 505 units or whatever it may be. MPAC looks at that and says that's an encumbrance. It's not, in our opinion, and it is currently being debated. And we've got about 13 buildings in that category under appeal right now. We firmly and strongly and adamantly disagree that they can't be valued in the same light, and whether we apply a variance in the cap rate or we apply a variance in the application of the fair market rents that are afforded to it, they need to be addressed. And we are continuing to push on that debate. So stay tuned as we move forward. But right now, MPAC refers to it and stays behind this fee simple if unencumbered. They call it an encumbrance. Many of you are negotiating term sheets with a lender. CMHC offering the MLI Select program, where for a term you'll provide affordable housing, and by extension, then you will receive an offset on your rates. That, unfortunately, is an encumbrance. In other words, it's a negotiation between you, the landlord or developer, and the lending institution. And you've agreed to a term and a set of rules to abide by in that obligation. That, by definition, is an encumbrance. It's not something that is registered on title in that sense of you're not a building that 40 stories unless you provide 30% of those units in the affordable category. And as such, that's, in our opinion, the difference. And we are looking to the legislature to say, we either now need to get a court decision that sets out how we are to value affordable, so that even those units that are captured under the MLI Select program, we can incorporate into that affordable debate, because they should be valued differently. It's just the way the definition of the Assessment Act is written. But when you extend that to what's registered on title and what was established by the sort of police power, if you will, in that planning or regulatory process, that I now have to provide, 99 years or 20 years or whatever that term sheet is relevant to those affordable units. Those, in our minds, don't fit within the current definition and should be treated today as two separate valuation tranches. So there's a lot going on in our world, and unfortunately, it becomes that much more exasperated when we get into a reassessment or a lack of reassessment and the base date is continued. Ron, if you want to just go to the last summary slide, I'll close this off quickly, as I know we're short on time, and I appreciate that everybody wants to get back to their day. But what we see is tax rates increasing at roughly 4.5%, 4.7% per year, to the very asset class that we're trying to promote and create opportunity for. And contrary to legislative intention, tax increases on new multi-residential properties are outpacing any other asset class. Seems kind of counterintuitive. The Bill 140 or O.Reg 140, it has a diluted and watered down effect. And MPAC looks at it and says, perfect, the value just went up. And if we look to certain valuation characteristics, our continued debate on cap rates, our continued debate on affordable are, very much live and well. And we would request that if you have a new building in the city of Toronto or anywhere in the province, we need to come together. We need to fight this nuance of cap rates. We need to fight the nuance of affordable, and we need to come up with a program, because MPAC looks at it and says, well, those two buildings down the street, they're brand new, they've got affordable, and the landlord's happy. There's no appeals. Whereas your two properties down this side of the street, you do have appeals. If we're going to apply equity, they all should be done at the same basis. So I think it's important that all of us together, not that we need any more work in terms of appeals, we have lots of it, but what we're trying to do is come up with a structured and fundamental approach that when we look to value the newest component and those that are in the older category as well, that there's a consistent and streamlined approach, so that our basis of our debate and our ongoing discussions and ongoing debates with MPAC can be hopefully soon established in terms of how we should be approaching each type of property and how we should value each property. We have equity and that we have a transparent assessment and tax outcome. So on that basis, thank you for your time. Steve and I appreciate it very, very much. We'd be happy to take questions, and obviously happy to answer anything offline that was potentially you had in your relative to a personal property. Thanks for your time. Take care.
Thank you, David, and thank you, Stephen. And I'm just going to flash quickly up here if you want to take shots of this, but just to reiterate to everyone, everybody who's registered for the webinar will be receiving a follow-up email where we will have both David and Stephen's company contact information for all those, so they'll be in the email. We will also give you Dave's contact if you have anything relative to the side of development or anything else along the development timeline that's outside the taxes. We'll give you that information as well. But again, thank you very much, and I think we will just have the questions move into one-on-one contacting, and that way we can make sure that you have personal time with both David and Stephen. And if anybody wants to stay on to have any discussions, we'll just conclude the recording. We will formally thank our speakers, and we'll have conversations here following that. So thank you very much, everybody. Thank you very much, Stephen and David.